Welcome, everybody. Welcome to our inaugural Audit Insider webcast. I'm Dennis McGowan, Vice President of the Professional Practice at the Center for Audit Quality. For those of you not familiar with the Center for Audit Quality, or the CAQ as we affectionately refer to ourselves as, we are an organization dedicated to fostering high performance by public company auditors and advocate for policies, standards, and priorities that promote high quality performance by public company auditors. This Audit Insider webcast is a new series of webcasts that we plan to put on twice a year, bringing you updates and discussions on regulatory developments that are affecting the public company audit profession. And we're super excited to provide everybody joining today with CPE. I'm very excited to have a terrific lineup of regulators and leaders in the accounting and auditing profession joining me for this jam-packed hour. First up will be a conversation with Lindsay McCord, Chief Accountant, Division of Corporation Finance at the Securities and Exchange Commission, and Annette Schumacher, Senior Director in the CAQ's Professional Practice. That conversation will be followed by a brief panel with Mark Shannon, a partner at Crowe, and Mary Hoeltzel, Senior Vice President and Tax Global Chief Accounting Officer at CIGNA. We'll then change gears and I'll have a conversation with George Botic, Director of Registration and Inspections at the PCOB, and that will be followed by a brief panel with Liz Gantnier, a partner from Forvis, and Rohit, Elhance, a partner at Thornton. So welcome to all of my fellow panelists. Super excited to be with all of you this afternoon. And with that, Annette, I'll turn it over to you and Lindsay.
Thank you, Dennis, and thank you, Lindsay. Thank you, Lindsay, for being with us today. Lindsay, I thought we could start off our conversation by providing the audience with a behind-the-scenes description of CorpFin's filing review process. Could you provide us with an overview of the division's review program and the comment letter process, including, for example, how CorpFin's OCA and the SEC's OCA fit together in the process?
Sure, Annette. Thank you for having me. One thing is I do want to provide the standard disclaimer that everything I say today is my own views. They're not the views of the commission, the commissioners, the chair, or the staff of the division. So with that being said, this is a common question we receive is, what does the disclosure review program of the Division of Corporation Finance do? How do they approach when they open up a filing? What is the process that they go through? And I'm always eager to talk about it because it feels like a mystery if you're not involved, but it's not as big of a difference than what any accountant at a public company or audit firm or advisor does. So just to remind everyone, the Division of Disclosure, the Division of Corporation Finance, part of our mission is to ensure that investors are provided with material information in order to make informed investment decisions. So that is the mission that the accountants and attorneys in the Division's Disclosure Review Program focus on when they're reviewing filings. And, again, another refresher, Sarbanes-Oxley mandates that the division undertake some level of review. It doesn't say what level of review of each public company at least once every 3 years. And we do actually review a significant number of companies more frequently than every 3 years, which I'm sure if there is a preparer in the audience, they could vouch for that statement too, because they probably received a comment letter more than once. But we also review all the transaction filings, the IPOs, any other registration statements, business combinations. And when we set up a review team, it'll include normally more than one accountant and sometimes a few attorneys. And there is at times their managers above them will be involved, but traditionally you're working with that core review team when you're engaging in the comment review process. How we determine who reviews public company filings is all based on how our disclosure review program is kind of organized, which is by industry offices. And we currently have 9 industry offices. So we have finance, crypto assets, real estate and construction, energy and transportation, life sciences, industrial applications and services, trade and services, manufacturing and technology. I'm sharing all 9 names because we used to have them on our website and they're no longer there. So it's another common question we get is, what are the industry offices that my filing is going to go into? And how we determine which companies fall into which industry office is all based on the business activities of the company and the standard industrial classification, the SIC code of that company. So as an example, the Office of Industrial Applications and Services, this was an office established in the last year. It includes public companies focused on agricultural, chemical, medical technology, and healthcare delivery. So a large range of different types of business activities. And we try to approach the review process with the understanding that a company also has sensitivity and timing. So for example, we try not to send out an initial comment letter on an annual report after the completion of a company's subsequent fiscal year. So for example, in January 2023, we're generally not reviewing any sort of December 31st, 2021 10Ks. So we do take in consideration a company's timing and the fact that the auditors have already moved on from that annual report audit and are focusing on the next one. And we do allow for companies to offer, to request an extension for our comment letter response of up to 10 days on annual reports, because your time as whether you're the auditor reviewing the comment letter for your client or as a client, you might need to spend more time and diligence to answer the questions, and we want to make sure you have that available to you. So when I say what the accountants in the group do, it's similar to what an accountant at an audit firm, advisor, or company does, is they pick up the filing and they read it. But when I say they pick up the filing, they pick up several filings. So all the SEC filings will be part of the process. We also review any public information. So whether that be the company's website, their presence on social media such as Twitter. And a lot of that is to provide us context for the filing review and how the company's approaching the mandated disclosure requirements. There is no magic disclosure checklist the SEC staff is using to determine what to comment or what not to comment on. I know some other foreign country regulators disclose like their priorities for their program over the next year. The SEC Division of Corporation Finance, we do not do that, but through conversations like this, we often try to share what are their emerging trends or things that are top of our mind. Also, when it's a technical accounting comment or financial reporting, that is when more than just that 4-person filing review team may be involved in the process of discussing or analyzing the response from the company and the disclosures. So that's where kind of the division's Office of Chief Accountant, which I lead, comes into play, but also the agency's Office of Chief Accountant can also come into play. So when there's a complex accounting issue, maybe 1 or 2 rounds of comments have been issued by the initial filing review team, and those comments are generally being issued to get more background information. So I would say it's safe that the first round of comments is normally asking for information. There is no conclusion being determined in that first round about disclosures or the accounting. Again, that's a general statement, but it's normally after we kind of get some more information that the staff starts analyzing how has the company determined what their accounting and disclosures are for that transaction. And we're asking things like, tell us what authoritative literature did you rely upon to determine your accounting? Did you consider alternative literature? And if so, what was that alternative literature and why didn't you select it? We love it if a company offers this information up, obviously. Who wouldn't love additional information? We know investors love additional information too. So, that is one of those best practices. If you can go ahead and the initial response provide a more detailed analysis and discussion, it's helpful to us because then we are able to be more efficient in our process. And if it's truly a technical matter, let's say it's something that it's an industry-wide accounting issue, Annette, or maybe it's a precedent setting, like this interpretation of GAAP has never been taken before. Those are the things that go up to the Office of Chief Accountants in the division. And that additional detailed information allows us to make an assessment. How big of an issue is this? And should we as a division now consult with the Office of Chief Accountant of the agency? And that's where the office that Paul Munter leads as the Chief Accountant of the division of the agency comes into play. They work closely with Corp Fin on complex accounting issues noted in filing reviews when the consultation happens. They also have a process where they work directly with registrants for pre-clearance of accounting and auditor independence matters, which again, you normally have a Corp Fin representative in that sort of consultation process. And that's really just to kind of help the preparer along too, so that your filing review team already knows that you've asked the question to OCA, where are you in the process, and then what's the conclusion. So we try to limit the possibility that CorpFin might issue a comment that would necessarily contradict the discussion you had with OCA. You know, we all have our own checks and balances in place and internal controls, even here at the SEC. We also work closely with the Office of Chief Accountants on other matters that maybe are related to rulemaking, because our division does do a heavy amount of rulemaking. You know, all these disclosure requirements did not pop up overnight. There's been a lot of thought process in it. So any sort of rulemakings that involve accounting and financial reporting, generally the agency's Office of Chief Accountant would also be assisting with that. And then also in the Office of Chief Accountants for the division now, we actually have a broader role than supporting just the disclosure review program and the rulemaking. We also answer other interpretive questions directly from registrants, including we answer waiver letters on financial statements. So we all kind of work together. So similar to what you think of an audit firm, they have their audit team. We have our disclosure review program staff. Then they have their national office. They have CFOCA, or maybe they have a regional like SEC person, that would be the CFOCA, and then their national office being the agency's OCA. So that's kind of how we are organized and work through accounting issues. Happy to go into any more detail if you want on like tips or best practices for comment letters before we move on to any other topics.
That is super helpful, Lindsay, especially in providing kind of overview of how those two offices interact and fit together. So thank you so much for that. In terms of 2022, have there been any overall reporting themes that have emerged from the 2022 filing review process so far? For example, were there any areas that were disclosed particularly well that you'd like to share with us?
Yeah, so I said that we don't highlight the same way that other countries do about our focus in CorpFin for reviews, but in some ways we kind of do that indirectly with moments like this and speeches, but also we issue public guidance to registrants on emerging disclosure issues. So I think that kind of gets to the question you have of like, what are the disclosure themes we've seen in the 2022 filings, and actually what really people have done well. We traditionally see people do things well when we've actually provided some additional disclosure guidance. Companies are really responsive when we provide. It's not that they're not responsive beforehand, it's just understanding a little bit more of what are the questions the staff are asking themselves when they review disclosure. We found and we've heard to be very helpful to preparers and their advisors. So we have issued a number of Dear Issuer letters or disclosure guidance topics on emerging issues over the last few years that we've seen companies be responsive to. I would not expect that companies were yet responsive maybe to the one that we issued yesterday, a Dear Issuer letter yesterday on China-based issuer topics. But that was not the first one we've issued on that topic. We issued things in 2020 on COVID-19. We've issued about the conflict between Russia and Ukraine, the crypto market volatility. And so again, when we issue this shortly after, we noticed the 10Qs and the annual report really seem to kind of step up to the level of disclosures that we would hope for people to do. And the fact that we tried to publicly say that things like the COVID-19 disclosure guidance in 2020, a lot of people have moved past the pandemic and COVID-19. And so probably are not looking at that disclosure guidance again. And I've actually gone out and said, it could be worthwhile taking a second look at it and just removing the word COVID-19 everywhere and replacing that with any other global event or emerging topic, because some of the questions in there about your financing, your liquidity, are things that actually could be asked on other trends and events. And so I've noticed saying that and putting that in a very basic way of thinking, we see people really respond better and say, oh, you're right, let me take a fresh look at my disclosures. I wasn't thinking about the fact that I know internally maybe my Treasury department changed our investment strategy because interest rates were rising, but I haven't disclosed that to anyone. And actually, you know, I'm an insurance company and my investment strategy is very important to my business. And so we try to do this again to elicit that good disclosure and maybe additional things that are actually top of mind, are happening in the board meetings or happening in the CFO with the CEO or the VP of accounting or whatever, but not always appreciating that investors also want to hear that same information. So big themes definitely this year was inflation. Has it changed the outlook, business goals and sales profits of the company? The rising interest rates. I cannot stress enough of how important those disclosures are in these times of, it's changing people. If you have to now, it's your normal time to renegotiate a borrowing or a line of credit, it could look very different than it did 2-3 years ago, even a year ago. And so, those are important information to share with your investors. The other thing I would add to this is supply chain issues. That's something we're seeing companies do a pretty good job about discussing with their business and how it's impacting their pricing to their customers, how it's impacting the cost of sales and the gross profit. So please continue, everyone, to keep up the good work here.
That's great news. Is there any areas that you kind of saw that we had room for improvement? Anything in that regard that you'd like to highlight?
Yeah, I would still say interest rate risk disclosure, specifically under item 305 of Regulation SK, is something that everyone could look at, especially if you have a large investment portfolio. The other thing is critical accounting estimates. We made some changes to, we simply codified, we thought, the interpretive commission guidance on MD&A, but we've had some dialogue with companies that they thought it was more than codification. And specifically related to critical accounting estimates is the lack of quantitative information and really the sensitivity analysis disclosure that we're just not seeing companies really provide as much robust discussion. And when you have this inflation changes and when you have these rising interest rates, we know there's sensitivity going on with accounting estimates that could materially change that estimate. So we would be expecting in 2022, we expected, and I think going forward still in 2023, more dialogue about critical accounting estimates. The only other thing I would add is not my favorite topic, but the one I talk the most about, non-GAAP. We issued guidance in December, and the intent behind that guidance was all to actually get preparers, their advisors, and whoever else is involved in non-GAAP to take a fresh look at their non-GAAP disclosures, because the comments that were being issued were significant. It's one of the highest comment trend areas, but the highest comment trend area in non-GAAP is on prominence. And it is what I would refer to as basic non-compliance. It is companies starting a non-GAAP reconciliation with a GAAP number, with a non-GAAP number instead of the GAAP number, or providing a whole entire detailed, robust MD&A on the non-GAAP measure, and then skin and bones for the actual GAAP MD&A, or a full non-GAAP income statement. Very basic things. So that guidance really was trying to hone in on the lack of compliance here for things that are what we believe basic requirements under the rules and guidance, and hopefully improving that. That's
very helpful, and even the stuff that you guys put out, I think is always really helpful. You can see the definite relationship between when you guys put out something and the understanding on the other side. So that's great. Really quickly, for turning to a specific topic on compliance with the new pay versus performance disclosure rules. It's kind of a topic that's on top of everyone's minds these days. Are there any messages you'd like to relay on how our audience might best comply with these disclosure requirements and how the division is approaching its reviews of the disclosures?
Yeah, first simple thing is make sure you're getting the accountants involved in the development of the disclosures. A lot of the disclosures are based on accounting principles in US GAAP. So the knowledge of your accountants are going to be really valuable in addressing the complex compensation arrangements and how to present those disclosures. Our director earlier this year informed everyone that, the division is taking it since we're appreciative of the fact that preparing the first year disclosures for any new rule is difficult, but we're kind of sensitive to the fact of the proxy season and the timing of these disclosures. So we focus more on the material non-compliance of those companies that included no disclosure. didn't address anything for paper's performance. And some of those companies received comments, had to maybe change meeting dates, had to amend proxy statements. But all the rest of the review is kind of being done behind the scenes with the intent at the end of the season for us to provide more information and the comments to be focused more of like going forward in your next year, here's some areas of improvement. And we're still thinking about how to message that other than the traditional comment process.
Okay, that people will be very interested in that. So thank you so much, Lindsay, and thank you so much for taking the time out of your busy schedule to be with us today.
Thank you for having me.
And now let's turn to Mark, Shannon, and Mary Hoeltzel for a discussion on this year's filing season from the public company auditor perspective and the registrant perspective. Mary and Mark, I'll address my first question to both of you. Lindsay provided a very helpful overview of the staff's filing review process. Mary, from a preparer perspective, and Mark, from an auditor's perspective, can you share one best practice that you have found helpful in facilitating the review process? Oh, Mary, I think you're on mute.
Oops, sorry about that. I'm happy to share what we do at CIGNA. Just to give a little context, CIGNA is a health services company. We're a Fortune 12, just so the audience has some idea as to what type of company we are. We actually have a very extensive review process at CIGNA. We have 4 layers of review. So we have our internal accounting, our legal team conducts a review. We have 2 disclosure teams. One is really comprised of my peers, senior vice president level, treasurer, investor relations, SEC counsel, et cetera. And then we have a second committee, which is our executive disclosure committee, where we actually review the filing with the CEO, the CFO, and our general counsel. And then, of course, lastly, we have the audit committee review. In terms of best practices, we do use a checklist. I don't know if it's a magical checklist, but it is a very extensive disclosure checklist that our auditors, Pricewaterhouse, provide to us, and we find that very helpful. And I would say the unique thing I do relative to that is we assign specific elements of the report to our accounting, finance, and legal team. And before we even have our disclosure committee meetings, those individuals, along with my SEC reporting group, prepare documentation to support every number in the section that they've been assigned that's in our filing. And we review that with them. We review the calculations, et cetera, with the intent to ensure that we don't have any errors, misguided assertions, assumptions, et cetera. So I would say that's probably the biggest best practice that we deploy. Mark?
Yeah, I'll frame my best practice up from the perspective of receiving a comment letter, because that's really sort of the end result of the staff's filing review process. Mary, everything you said just resonates with me. Love to hear about your process and your procedures. But when I think about it from an auditor's perspective and getting that comment letter, the best practice I can tell you is, and I'm glad Lindsay mentioned this as well, get your auditor involved in that comment letter response as soon as you get it. And there's really 2 reasons for that. One is to avoid surprises. Lindsay sort of teed this up, but auditors need time to look at your responses. We need to evaluate whether or not there's any impact to the financial statements or other information that we looked at when we signed our audit opinion. And getting us involved early in the process really stops the surprises at the back end, which, right before you make your response to the SEC, you don't want your auditor calling to say, hey, by the way, we need some more time to look at your response. And then the second thing I would point out is auditors can help you. So the company's going to own that comment letter response process, but we might have some advice to provide. We might have experiences on other clients that we can impart to you to really help companies respond to those comment letters.
Thank you both. Mary, this one's for you. Lindsay mentioned a number of reporting issues that arose during the last reporting cycle. From a preparer perspective, are there any particular reporting and disclosure areas that your team grappled with? And were there any lessons learned or best practices that emerged?
So I'll sort of answer the question sort of aggregated. The answer is yes, yes, and yes. I would say that we did make some changes to our business, but I'll focus on those that I think would be more germane to a wider audience. So inflation, supply chain, and investment disclosures. Those were 3 areas that we really honed in on in preparing our 10K in 2022 and then updating it in 23. We contacted our CFO, we worked with our ERM group, and we actually set up a task force to review inflation across the enterprise, all elements of inflation, to see whether or not, if inflation creeped up by so much, which is what they were predicting, would that have a material impact on our business? And would that be something that we would have to disclose? So the task force, compiling that information, analyzing that information was one thing that we did. With respect to supply chain, part of our business is drug procurement. We sell medical drugs to a lot of companies that probably are on this phone. And we spend a lot of time with our supply chain leaders, talking to them about the supply chain. A lot of the components that make the drugs come up from China. Our relation with China has been a little testy, particularly of recent years. And so we spent a lot of time with them talking about, do we have alternative avenues for procuring drugs if in fact something were to arise with China? So that was another area. And then the third area was obviously investments. I think Lindsay touched on this when she touched on interest rates. Many companies, especially insurance companies, we have a very substantial investment portfolio, and interest rate risk resulted in the rising rates, resulted in our investments experiencing unrealized depreciation. So we really had to take a very close look at that. We enhanced our disclosures with respect to that to ensure that, are we planning on holding these investments to maturity? And if not, do we have capital gains to support them? So we had additional tax disclosures that we provided. And then office properties in commercial real estate are really experiencing some stress these days and some weakness. And so we added some loan to value tables and additional disclosures on those properties.
Mark, how about for auditors? Were there any particular topics that were top of mind for you this reporting season?
I'm going to go with yes, yes, and yes, just like Mary. So, I think the things that Lindsay mentioned, rising interest rates, inflation, supply chain, those all resonate with me in terms of risk assessment. So as we as auditors are doing our risk assessment process, we're trying to understand the company to identify those risks of material misstatement. And rising interest rates, that can impact liquidity, that can impact your investment portfolio, that can impact impairments. It can impact, Lindsay mentioned, critical accounting estimates. So we tend to think about that all in terms of how do we think about the risk of material misstatement and how do those emerging risks impact all of those material accounts and disclosures that we're thinking about as we perform our audit. So it's really, as Mary mentioned, yes, yes, and yes.
That's great. This has been a great discussion. Thank you both so much for taking the time to be with us today. I'll now turn it over to Dennis, who will kick off the PCOB portion of our program. But thank you both again.
Thanks, Annette. Thanks, Mark. Thanks, Mary and Lindsay. And thank you to George, who is joining us for the PCOB portion of our programming. So thanks for being here, George. So as Director of Registration Inspections at the PCOB, George oversees the Global Network Firm Inspection Program, the Non-Affiliate Firm Inspection Program, and the Broker-Dealer Auditor Inspection Program, as well as registration. So we're super excited to have you, George. SOX is turning 21 years old this July, meaning the PCOB inspection program, I believe, is turning 20 years old this summer. And so there's no doubt that the inspection program has really had a significant impact in improving audit quality of public company audits. And so I thought I'd maybe first start with asking you, what do you think firms are doing well?
Yes, Dennis. First of all, thank you for the invitation. It's a pleasure to be here this afternoon with you and the other panelists. And Like Lindsay, if I may, before continuing, let me give our standard disclaimer. The views I express here this afternoon are my own and should not be attributed to the board as a whole, or other staff at the PCAOB. And yes, Dennis, just to acknowledge quickly, last year was the 20th anniversary of the PCAOB, and this year, something maybe near and dear to my heart that I think is equally as important, is the 20th anniversary of our inspections starting in 2003. The limited inspections we began back then, and it's evolved obviously over 20 years. And I think it has been a journey for all of us, but I think it's fair to say that audit quality over the last 20 years, speaking very broadly across all firms, has improved, even though there's some ups and downs along the way. And right now, maybe not the high point, but overall, the trajectory, I think, has been an improvement of audit quality. And then just to your question, to pivot a bit about what firms are doing well, we think a lot and have been thinking a lot over, in particular, the last several years, not just in terms of deficiencies or findings or lack of compliance with the standard, which is our core focus is I think everyone probably knows of our inspections, but also when we're doing inspections, our inspectors see a lot of things in work papers. They see a lot of things that firms are doing. And we really have made an emphasis, again, over the last 4 years plus or so, to try to identify and pull out, if you will, of what we call them good practices, not best practices, but good practices across all sizes of firms is a key aspect of our inspection activity. And we try to take those good practices when we see them, we internalize them, if you will, and we bake those in, as you may well be aware, in the spotlight documents. We try to always include good practices there, as well as from public remarks or speeches, or just as we think about more broadly what firms are doing. So it is a key aspect of our overall inspection work. And with that, let me, if I may, provide just 3 examples in our limited time of good practices that come to mind at a broad level in terms of improvement of we believe, help to drive improved audit quality. The first one, and the term may vary by firm, but the notion of the timing of the audit work, the phasing of the field work before the balance sheet date, after the balance sheet date, before year end, after year end, if you will, and where firms have the ability to track the timing of the cadence of the field work, again, pre-post balance sheet date. In those cases, we generally see improved audit quality. And I think it's fair to say in those cases, not just the tracking of it, but when a greater proportion of the work is done pre-balance sheet date, there seems to be more of a direct correlation between improved or higher audit quality than when more work is done after the balance sheet date. And the other point I would add to that quickly is where firms have created or established specific or formal milestones or percentages. So it's not just do more work before year end, but here are some various targets, and they have the ability to track those targets. And if they see if they see an engagement team is getting behind for whatever reason, then there's pauses. Okay, let's what do we need to do here to get caught up? So I think that's one broad bucket of a good practice is tracking centrally the phasing with milestones. The second example I'm happy to provide relates to the risk assessment, and I think it relates to two pieces of the risk assessment. One, ensuring that there is sufficient time and thought at the beginning. It's not something done, as in a moving train. It's before the train starts. Let's think about the business. Take time to understand the business, the strategy, and what the risks are. Develop that granular risk assessment, and that time will be time well spent. And then I think with the direct linkage to when you identify the risk and material misstatement, what is the audit response? One specific example in this space that we've seen that we think is a good practice is one firm's risk assessment templates help engagement teams capture the linkage between the risks of material misstatement and the controls that were identified for testing, the specific controls that were identified for testing to address those risks of material misstatements. So that's one small thing that a firm did, but it seemed in those scenarios to work very well to provide engagement teams that direct path, provide that linkage. And then the third item I mentioned just quickly is engagement quality review process, the EQR process. Firms in many cases have put a specific emphasis on the training, on the information sharing with their EQR reviewers. Things such as in the annual training process, they specifically highlight both external and internal inspection findings and call those specific to the attention of the EQR individuals, so they know what's being identified, so they can help focus their review. Is part of these broad trainings or beyond the inspection findings or results are reinforcing the identification of significant risks, including fraud risks, and how the EQR thinks about theirs as they do their review. Are there barriers that are becoming challenging to the EQR process, to tease those out through these broad discussions, as well as ensuring that the individuals understand and are aware of all the tools the firm has to assist the EQR in his or her review. So Dennis, those are a few of the things, again, thinking broad terms where we've seen better or improved audit quality. Those three areas kind of bubble to the top.
Thanks, sure. That makes a whole lot of sense. And I think it's really helpful for our audience to hear those things that the firms are doing well. So I think it's really nice that you guys are highlighting some of those good practices, because I think that's certainly very helpful in improving audit quality. So on the flip side of that, where do you think there's opportunities for auditors to improve?
Yeah, Dennis, happy for that question. And the way I think about it at a broad level is not just improve, but continuous improvement, with the view that this is an ongoing process, that the auditor or the audit firm should not have a mindset of one and done, that I'm going to fix this one targeted problem and wash their hands and they think it's been fixed. I think this is really a process, particularly when you think about, and just listening to Lindsay in the last panel, all the things that are going on, with supply chain, with interest rates, just a broad uncertainty of the economy, the geopolitical environment. We just can't catch a break here, but all those items, it really underpins, I think, the importance of this continuous improvement mindset that the auditor and the audit firm more broadly should have on an ongoing basis. And I think the next step, when you think about continuous improvement, at least when I think about it, it brings to mind the importance of the auditor and the auditor's role as a gatekeeper in supporting investors and the needs of the capital markets, which I think we all would agree, I believe that the auditor's work as a gatekeeper has made our capital markets the envy of the world. And that's not something to be taken lightly, and obviously wouldn't have to be that way. But I think the auditing profession has in their gatekeeper role has really brought us to that point. And I think, again, that continuous improvement aspect. So a few things that I think about at a broad level in terms of areas of focus or improvement that come to mind. And I'll pick up in a way with the risk assessment I just mentioned a moment ago. And I alluded to this, but I think that auditors taking time, pardon me, at a detailed engagement team level, the lowest levels, ensuring that they understand the business in a detailed way, understand the strategy in the detailed way. I think most auditors will say, well, of course I understand the business, but I really challenge auditors to ensure they're taking the time to understand it, because when you think about related party transactions, you think about fraud procedures, you think about being professionally skeptical. Can you be professionally skeptical without a deep understanding of the business in a way that's meaningful from a risk perspective? And I think about those couple areas in particular, due diligence in terms of taking the time to make sure things are done well from an audit perspective, well documented. A couple other areas, Dennis, just to mention, and if I allude this is fraud procedures. Don't ever underestimate the importance of fraud procedures, particularly in challenging economic times, but just on an ongoing basis. CAMs, critical audit matters. This is something probably for followers of the PCOB that we're thinking a lot about. We've heard from investors and others. Critical audit matters. The average number of CAMs seems to be declining. It's something that we're thinking a lot about. Our auditors doing sufficient work to identify CAMs. So that's an area I certainly would encourage auditors to think about and teams to think about as they're going through their audit. And then maybe more broadly, from the firm perspective, is the root cause analysis process, ensuring that the firm, as part of its system of quality control, when observations are identified through outside inspections, internal monitoring reviews. I mean, even, and this is equally important, even when things are going very well, why did it go very well? Why did it work here but not over here? Don't just focus on over here, but think about both sides of the coin, the good and the bad, as part of your risk assessment analysis. And all of this, I think, is critically important when we think about, as we're sitting here today, and there's been a lot of discussions coming out of the PCOB about our findings, et cetera. And as we sit here today, well, again, the trajectory of audit quality, I think, is improved, but we're seeing, looking at one metric of our inspection findings, broad-based, an increase in our findings through last year's inspections. And it's troubling. And it's something that I think, as we think about the 2023 audit cycle, I would encourage auditors to be thinking about inspection results more broadly, thinking about what's coming out of the PCOB, thinking about coming out of the SEC, because things right now tend to be trending not in the best direction. Globally and directionally, we issued approximately 23% more comment forms in 2022 than 2021. So I would just say that I'll use the word slippage, Dennis, if I may, the slippage in audit quality, at least at the moment, and we can talk a lot about the underlying root causes, but that slippage in audit quality does beg the question, are firms reacting with the appropriate sense of urgency relative to the quality in uncertain economic times? And if not, why not? So I'll pause there, Dennis. Those are some of the things that we think about. We think about the current state of audit quality.
I think that's super helpful for the audience to hear kind of those things that you're taking a look at, and those areas to maybe be a little bit more focused on in certain respects. And so I really liked your lens around continuous improvement and kind of where what can we learn from each inspection cycle to improve next year's audit. So I think that's a helpful lens by which to look at it. Maybe switching gears a little, it's just still inspections, but more from the reporting standpoint. In April, the PCOB announced some format changes to their inspection reports, and maybe I thought you could describe a bit about how you think this increased transparency is going to help the users of inspection reports, maybe any potential risk for misinterpretation by users of the information. And so maybe I'll just pause there and kind of let you respond to those questions.
Yes, happy to, Dennis. I couldn't be personally more excited about the expansion of the inspection reports. I think that the increased transparency, and we continue to think about transparency more broadly, but the announcement we had in April to expand the inspection reports to include additional information, we believe they will be helpful to investors and other stakeholders. Probably the biggest change I'll touch on is what we call Part 1C. We have Part 1A, B, and C now. Part 1C is independence. So for the first time in the public section of our report, we will be disclosing independence violations that either we identify as part of our inspection results and our inspection work, or the firm identifies through its internal monitoring process. So there's two pieces to Part 1C, the firm identified and the PCOB identified. And we think that will be, given the importance and the fundamental nature of independence to the auditor and the auditor's work, will be very important and helpful for outside stakeholders. We do have some other changes to Part 1A of the report. The other one I'll just flag quickly. In the annually inspected reports, which haven't come out yet, there will be some new charts and tables that reflect both partner and firm tenure that heretofore was not readily available, if you will, in our report. So that's probably the other change I'll flag. And the last thing, Dennis, if I may just quickly on changes, you may have seen, I'll call this out, and the timing is a coincidence, but this morning, a few hours ago, we did announce some changes to our website that we also think will be very helpful. There'll be a search feature that'll allow an individual to search on the deficiency rate of Part 1A findings on a sliding scale, and some other characteristics that we think will also be helpful. We're thinking about website transparency as well in many different ways. So I think you'll see an evolution of this going forward. And then very quickly, to your point about unintended consequences, we do think a lot about that. In the context, and I'll say the context that we disclose matters. We can throw a lot of data on the website or in a report, but personally, I'm not sure that's always as meaningful without context around it. So we think about the context and can someone understand what it really means and what it doesn't mean. And we've tried to provide a number of cautionary sentences in our reports, now on our website, that hopefully will we believe will help a reader put this into perspective about what it is versus what it is not. That will avoid, and I think personally, I think it will, but there'll always be questions, I suspect, but we'll avoid any unintended consequence or unintended interpretations of our new information.
No, I think that's helpful. And I think definitely we're excited about some of the new reporting, and I was going to ask you, I didn't want to pull a gotcha and ask you about the announcement this morning, so I'm glad that you mentioned that, because we did see that come out. Maybe kind of the last question on inspection reports, but just thinking about investor protection being core to the PCAOB's mission, and even as you were mentioning, kind of auditors being those gatekeepers for investors, you know, how does the PCAOB think about the needs of investors when determining and communicating kind of the findings that they include in their reports?
Yeah, great question. And we could probably talk all afternoon about that, truth be told. But in a minute or two or less, I'll try to summarize. You know, the core mission of the PCAOB and our inspections is investor protection. That's the heart. That's our why. It's our North Star is investor protection. And we think a lot about all the information that we have, what will be most useful, whether it's, you know, through transparency. We just talked about the website, inspection reports, the timeliness of our reports, which is certainly something we continue to work on, the timeliness. Thinking about spotlight documents. We get a lot of information from the investor advisory group, from the standing emerging and issues advisory, the CIAG. So we take all that information, other stakeholders provide us information. We try to distill that, you know, what we think will be most useful and relevant to what we're doing and what we're able to convey. Again, I'll say with context. Very quickly, Dennis, just to highlight a couple things that we are very focused on, spotlight documents. So we've recently, in the last probably 3 to 4 months, have issued a handful of spotlight documents. One on an audit committee resource that we think provides questions that will be helpful, you know, memory joggers for audit committees relative to the interaction of the auditor to the audit committee chair. We had a spotlight on crypto assets, digital technology information that was reflective of findings that we've seen over the last couple years that we thought, as I thought anyway, but I think we thought was very helpful to provide information for firms that are in that space and think they should be thinking about. And the last one I'll just mention right now is our priorities for 2023 inspections. We try to provide a number of data points on where we're focusing, what firms should be thinking about. But we also think these, while some of these may be more firm-centric, I will admit, but from an investor perspective or an audit committee perspective, I think they do provide a broader mosaic of what we're seeing, what we're doing, and things that they should also be thinking about relative to auditors, audit quality, and even the financial reporting ecosystem as a whole.
No, I know we find those spotlight documents to be really helpful. So thank you for highlighting those. Well, George, I really appreciate you being with us this afternoon, and thank you for talking about inspections and inspection reports. And what's top of mind for you and your division of the PCAOB. We really appreciate it. So thank you.
Thank you very much. Thank you for your time.
And so Liz and Rohit, I want to bring you guys into the discussion now. Been waiting all hour to get on the Jumbotron.
This was all very good discussion, very insightful. So I loved listening to Lindsay, George, and then both our panelists earlier. So,
Yep.
Well, thank you both for being here. Maybe first, you know, we just heard from George on inspections, inspection reports. You know, so Liz, maybe starting with you, any reactions to what George just covered?
Well, I think the first reaction is 20 years goes by pretty quick. It's hard to believe it's been that long. But on a serious note, what I heard, and something that is near and dear to every auditor's heart, is the importance of planning. You know, so he talked about the timing of field work, whether it was at interim or final, the phasing, and that the more time spent at interim. Well, to me, what that messaging is about, giving yourself ample planning time and thought-provoking time and bandwidth and sufficiency so that you can really think through the business and really think through how risks have changed. His second comment was on risk assessment. Well, and again, in my mind, risk assessment is about planning and using your limited audit time and our clients' audit dollar as wisely as possible. And understanding where the risk of material misstatement is, not forgetting about our responsibilities for fraud. And so to me, you know, I certainly appreciate all that George brought to our attention, but for me, the big message is make sure you've got time for planning.
I think that's super helpful, Liz. Rohit, any reactions from your perspective?
Yeah, so look, I think I agree with everything that Liz said here. And I think just reflecting on what George was saying, look, there has definitely been improvement on audit quality. And but again, like he said, it's a process for continuous improvement. So there are things that everyone can do better. So that's there. I think, and just in terms of the first-hand information on the inspections, he did talk about some of the statistics on the trends and everything. I think, at least in the last year, 2 years, 3 years, that there is, PCAOB has been very concurrent with what the market events have been and what the way the disruptions and all have played out, and in terms of what impact does it have on the financial statements. So I think it ties back to the risk assessment piece, that how robust are the risk assessment procedures that have been performed, right? So, and how do all of these disruptions kind of play into it? You've had like COVID issues, you've had the Russia-Ukraine war, supply chain issues, right? So all of this, how does it impact your risk assessment? So I think, and we have seen that PCAOB has been very concurrent in asking all of those questions, and also asking the firms in terms of how the firms are responding to some of these events on a timely basis.
Yeah, that's helpful. And maybe kind of still along the same lines of what we heard George talk about, but, you know, as we think about, you know, this, you know, next audit cycle, you know, what were some of the lessons learned from the most recent audit cycle, and some of that we heard George hit on. I think also we heard a little bit in the panel with Mark and Mary about, you know, the thinking about inflation and interest rate risk and all that. I think goes squarely back to risk assessment and continuously planning throughout the audit. But as you gear up for the next year's audit cycle, like what are the lessons you learned from the most recent one that you want to emphasize here? And maybe I'll start with you, Rohit.
Sure. I think I would probably say two things. One is just stay tuned in terms of what PCAOB is putting out. There are, George referred to some of the releases and spotlights, and also just be in tune into all of that, stay current. And then the other aspect to it is what I say, stop, assess, and think. So there is a lot of uncertainty. There are a lot of events, and it's an evolving space, right? So this does have an impact on the financial statements and the related audit. So just take the time, think about how some of these events can impact the financial statements, what are the risks there, and design the procedures accordingly. So I think that time that you spend on the front end planning the audit is very critical.
Thanks, Rohit. Anything to add to that, Liz?
Yeah, I think it's along the same themes of George's comment on continuous improvement. You know, we're all hoping that someday we'll get to that level of I've learned it all and I've done it all and I've done it right. But the second we get close, the bar changes and the economy shifts and interest rates change and wars break out and supply chains don't exist anymore in certain industries. And so I think just accepting the fact that, yeah, we're maybe never going to get there, but we're always trying to get there, and being okay with that, and allowing yourself time in the budget for thoughtful improvement. And he talked about slippage. Well, in light of all that has happened in the world, maybe that is not entirely unexpected, but as hard as everybody works and as tirelessly as we all try to move the needle in a positive direction, when things are moving and changing, we need to work even more tirelessly to move in a positive direction. So just double down on your effort, I think. Be deliberate about moving the needle.
I think that's super helpful, Liz, and that's certainly resonates when you think of all the events that have happened in the world these last several years. Each year has had some sort of major event or uncertainty that, were once in a lifetime type things. It seems like they're becoming more the norm, and maybe that's to be expected, and why that doubling down is so important. So I think those are all terrific points. So I know we've got just a couple minutes here. The PCOB has been quite active on the standard setting front. I know a lot of what we heard from George was related to inspections, but certainly don't want to not mention standards and kind of the activity coming out of that group within the PCOB. There's 2 proposals out for comment right now. The one of which is the auditor responsibility with respect to non-compliance with laws and regulations. So Liz, I didn't know if you wanted to maybe share with the audience in 2 minutes what's in that no-clar proposal and why it's important to comment.
Sure. So I think the big message here is that companies are subject to just a huge variety of laws and regulations that, if they fail to comply with, could have a substantial financial impact to an investor, especially if it goes undetected. The legacy or interim standards had phrasing about laws and regs that had a direct and material impact. The proposal that is currently outstanding, and the comment letters are due sometime, I think August maybe
7th.
8th. Yeah, 7th, 8th. Okay, right in
August
that time,
7th.
first week of August. So we're running up against that. It removes the phrasing about direct material impact, and they're purposeful about this and say, things that have an indirect impact can have a substantial financial impact to an investor, and that needs to be considered. So I think the challenge is, and I think the profession's comment letters back to the PCOB likely will focus on this concept of where does this begin and end? Because direct impact, things like taxes, pensions, I think we all understood that. It was part of our walkthroughs. It was part of internal controls over financial reporting. They were directly related to financial reporting. You get into indirect and suddenly it's not in our walkthroughs, and it's not in the client's internal control over financial reporting evaluation. And how many laws am I going to actually know? Laws are going to change by locality, by product, by industry, by foreign, by domestic, etc. And so it feels rather broad reaching, maybe too broad. But this, we'll see where this goes. But I think everyone agrees that compliance with laws and regs is certainly important to the investor, and certainly can have an impact on financial reporting. I think the question is, how do we put some rails around that so that the investors understand our responsibilities and where that begins and ends.
Yeah. I got super helpful, Liz, and spot on. And anybody on the line, just really encourage people to go to the PCOB's website and consider commenting. I know oftentimes the PCOB hears from accountants and organizations that represent accounting firms, but I think this is one where all stakeholders, so preparers, audit committees, auditors, investors, everybody should be weighing in. So really encourage folks to participate in the standard setting process. Well, Liz, Rohit, thank you so much for being with us this afternoon. To all the panelists, thank you. We know you were all tremendously busy people. Really enjoyed this insightful and informative discussion this afternoon. Feel free to go to the CAQ's website, www.thecaq.org, where we've got lots of information that is available and free of charge about public company audits. And don't forget to sign up for the Audit Insider newsletter on our website, and you'll get to hear from me on a monthly basis. So thank you again, everybody, and have a great afternoon.